Good morning, everybody. As Richard said, my role this morning is to share with you some figures and some thoughts on trends and issues in the market. I'm then in the privileged position of allowing other people to answer your difficult probing questions as they occur to you, which is great for me. But I do hope you do have questions. There's a lot of interesting issues that I think we might usefully cover and touch on. Very broadly, this is what I'm going to talk about: investment activity and pricing, a little bit on what's happening in the rental market and the occupational side of the market, and some of the issues beyond the normal stats and trends that we see, because I think we are seeing some quite far-reaching changes in what occupiers are thinking and doing and what consequences that may have for property demand. And then I'm going to try and wrap that up into a few thoughts and conclusions. It's very opportune that we're doing this in January. January is a good time to be, reflecting on what we did last year, how many New Year resolutions we've already broken, business planning, all that sort of stuff. So I did think I'd cast an eye back over what we said was going to happen, or what you said was going to happen this time last year. This is one of the findings from our investor intention survey from last year. Which sector is most attractive for investment purchases? Well, loud and clear, the message was, relative to the previous year, we're going to be buying more logistics assets. By far the biggest increase was attached to the logistics sector, and as you can see from that, it came in second only to offices in absolute terms for investment acquisition appetite last year. And that's a New Year resolution that has been kept in spades. This is what happened over 2013. We saw an increase in overall investment turnover in the sector of about 50%, 50%, to over 14 billion. It's the highest number since 2007 by some distance, as you can see from that. Where did that happen? You can see already a pretty variegated picture. It wasn't uniform across Europe by any means. Some pretty big increases in some perhaps unlikely places. Southern Europe, admittedly from a very low base in 2012, but big increases in Spain and Italy, also CEE, Nordics and Benelux. Even the UK, already, UK, France and Germany are already obviously the dominant components of that number, but those elements are up by 40% in the UK and 25% each in France and Germany. And you can see how that compared with growth in other figures, in other sectors. So there's clearly a great deal of investment momentum in the sector at the moment. Why is that? Well, there are lots of reasons, and we'll have a chance to explore them. Certainly, if one looks at the traditional rationale, I think it's fair to say that other elements of the rationale for buying logistics are much more widely accepted now. But the traditional income one, if you look at spreads between bond yields and property yields, at the prime end of the market, there is apparently a spread of 550 plus basis points between bond yields, German bond yields in any case, and prime industrial yields. So as a capital preservation play, as an income play, there's on the face of it, a very strong rationale for the sector still. And that has produced some quite big movements in pricing over the past year. If we look at some of the principal concentrations, key locations around Europe, there have been some pretty big prime yield shifts of 50 basis points or more, significantly more in certain places, London and Dublin prominent among them, but also Paris. And across a pretty broad spectrum of established logistics locations, prime yields have come in by at least 25 basis points over the past year. Where's that left them? Generally, in the 6.25, 6.5, 6.75 territory, as you can see from that. What we've plotted here is the current position relative to cyclical peaks and cyclical lows. And you can see in some cases, notably London, but not only London, that has taken the current pricing picture pretty close to its cyclical low, raising the question, how much further can that go? But in other places, perhaps places that have attracted less of the core capital that has dominated much of the market so far, pricing is still some way away from its cyclical low. Indeed, that's one of the reasons why it's attractive to value add and opportunity type capital. So perhaps scope for more movement in some of those locations. And that's really what's driven the market. Price value movements have predominantly, over the recent past, been driven by yield movements. What I've plotted here from over the period from 2002 is the respective contribution to value change of A, rental growth, and B, yield impact. And you can see it's been predominantly yield impact in both directions. So the 2004 to 7 period, falling yields driving rising values, the reverse in the downturn. A slightly more mixed picture in the recent past, but certainly if we look at the current number, it's those pricing shifts that we saw that have driven the market. A little bit of rental growth starting to come through in some places, which I'll come on to, but as yet, not very much. Those are measures of what's gone on at the prime end of the market. I think, as a bit of an aside, but interestingly perhaps, if we look at measures that are not exclusively based on the prime segment of the market, valuations of mixed or more mixed quality portfolios. Interestingly, firstly, the price trajectory has been less markedly positive, generally pretty flat. But I think interestingly also, there's a significant bifurcation there between logistics, which have done relatively well, and light industrial, which have, certainly that end of the market, have seen value reductions over the recent past. So perhaps reflective of the pattern of investment appetite, but perhaps also reflective of the emergence of opportunities in light industrial. We'll see. So that's a very brief canter through the investment side. What's gone on in the rental side of the market? Well, if we look at the pattern of year-on-year change in our EMEA rent indices in different sectors, and I've picked out peaks and troughs in the industrial and logistics one, hit a peak of 5% growth in 2007, got down as far as -7 in the trough of the market in 2009, and over the past year has gone up by a mere 1%. So there is some sign of stabilisation at least, if not the beginnings of some recovery in the rental market. Not particularly marked as yet. And moreover, very, very mixed. I've been deliberately selective here to make the point, but we have over the past year seen some very big variations in the rate and direction of rental change. So ranging from plus 20% in Oslo to almost -15 in Valencia. And it's not quite a pattern that defies categorisation. I mean, there is a more Nordics, Northern European flavour to the markets at the top of that graph, and clearly some of the Southern European markets under a bit more pressure, as you would expect at the bottom. But it's not quite as straightforward as that. It's a very mixed picture at the moment. Similarly, if we look at levels of leasing activity over the past year, a similar kind of conclusion. It's a very mixed picture. There are some big positives, Dublin, Lisbon, for example, and again, these are off for a fairly weak basis in some cases, but some big negatives as well. Significant contraction in Milan, Warsaw, indeed Amsterdam as well. For Europe as a whole, probably slightly down on 2012, but only very slightly. So in keeping with the rental picture that we described, there is a bit of momentum there. There is some sign of stabilisation. The question is how far that will continue. And I think if we look at some key economic indicators to give us a couple of clues as to the answer to that, the picture is one of, the expected picture is one of fairly gradual recovery. World trade expected to increase, imports and exports as proxies for the flow of goods around Europe expected to increase, getting up to around 4% or so over this year, 4% growth over this year and next year. So there is a gradual climb out in process. Again, that pattern is mixed. If we look at GDP growth, expected GDP growth over the recent past and the next couple of years, the expectation here is that 2014 is stronger than 2013 and 2015 is a little bit stronger again. And that pattern generally applies across all these locations. But clearly, as you can see from that, the absolute levels are very different. Not much growth expected in Southern Europe this year. Stronger in Germany, particularly strong in the UK, perhaps taking longer to get established in France. But that is running up against, particularly at the prime end of the market, in some places, quite a lot of places, diminishing, shrinking supply. Pick the UK here, again, to make the point, new supply, modern new supply, available in the market now is 71% lower than it was in 2009. So perhaps the pattern of recovery, occupier demand, in some places running up against shortages of supply at the prime end of the market. So what else can we say about the occupier market? I think one of the features of the upturn is that it's happening against the pattern of a fairly gradual recovery, but also that there are some significant changes, challenges, issues that occupiers of varying kinds are facing in the supply chain. There is, I think, recognition that finding ways to secure supply chain efficiencies will be very important for revenue growth and profitability growth in what, as we've seen, is a fairly gradual upturn. And, as we know, growth in online retailing and the necessity for restructuring and reconfiguration in supply chains in response to that are pretty significant factors that occupiers are having to deal with. And there are loads and loads of dimensions to this, which we're not going to have time to go into in detail, but certainly some of the things that I've listed here. Quite tricky CapEx decisions. Where should that be focused? Systems, people, IT, some mixture of both. The whole issue of order fulfillment and innovation in that area. Issues around centralisation of systems for inventory control. Same-day delivery. Can the economics of that be made to work somehow? And the issue of absorbing returns, retail returns, back into the supply chain, so reverse logistics. The mechanics of all of those things are quite challenging. And I think, summarising some quite complex issues, I think we're in a period where there is a quest going on for a seamless supply chain. We're not there yet, and there will be various trial and errors involved in getting to that point. But what it does do is, in terms of real estate, places a premium on things like accessibility, handling capability, the process complexity that a building can handle. And I think what we seem to be starting to see is a bit of a polarisation in demand between very, very big warehouse platforms and smaller urban logistics. If we start with the first of those for a minute, it's very clear from a smallish straw poll that we did, what are the advantages to an occupier from that? Well, centralisation of operations and the economies of scale that go with that are very clearly identified as advantages to occupiers of operating from that kind of platform. And we are seeing that the contribution of that to the occupier market is rising. It's up at 15%, nearly. And it confers a number of advantages in terms of efficiency of operation, simplification of supply chain patterns. From an investment point of view, there are some issues to consider. Relatively long production cycle, perhaps it creates demand in some somewhat unusual locations. So are there alternative use or reletting issues that occur here? And the obvious one is they're pretty large lot sizes, so single asset risk. At the other end of the size spectrum, urban parcel delivery centres. One of the things that we see here is that the possibility of demand being created for these around the fringes of, theoretically, almost any major town or city around Europe, given that they are servicing and need to be close to big centres of population. These are fairly simple, high throughput, get the goods through one side and out the other. The issue is really one of scale. The design template, I think, is becoming clearer. The advantages here are fairly obvious. Rapid transfer of goods, reduction in inventory holding, faster process speed, ability to siphon goods in either direction around the end of the supply chain, and the final mile, or the final 1.6 kilometres, as I keep being encouraged to say, close to the end of the point of consumption. These are things that allow you to do that. From an investor's point of view, that ought to be a set of things that's appealing. There are issues to be addressed, some of which I've listed here. There is evidence that we've seen of rental premium, which is necessary given the lower site coverage. Whether the market is entirely convinced by and pricing for that evidence is an open question. But there's a fairly limited scale of capital market in this segment, certainly in most of Europe anyway. Whether that represents an opportunity, which I think it does, or a risk, maybe we'll hear. So, some broad conclusions. We saw last year a very, very strong investment tilt towards the logistics sector from a variety of different sources of capital actually last year. So there's a lot of investment momentum and pricing momentum. As we saw, yields narrowed in a lot of places, not everywhere, but in quite a lot of places and by quite a significant amount. But spreads are still large. Rental growth is starting to emerge in the stronger markets. How fast and where that emerges may be a strong determinant as to investment appetite going forward, given the pricing changes that we've seen. There are some very far-reaching and rapid supply chain challenges going on. Apart from anything else, that makes it more important to understand what occupiers are doing and thinking and what's driving their behaviour in a period of upturn, but not particularly rapid upturn. That, we think, produces the possibility that more niches, perhaps new investment products, will emerge, and there are a range of issues around that it's important to understand, I think. How do we price specialisation? What is the premium attached to single asset risk? Are there first mover advantages, and what degree of pricing improvement as those sectors mature might be expected? So that's it from me. I'm going to hand back to Richard.
Great, thank you very much.